Hello, morning all. All right, welcome back to the Morning Cup by 8. Aiman here. All right, so looking at the S&P 500, well, it closed slightly higher, snapping the two session losing streak as the AI stock led the I would say, rebound ahead of Nvidia's crucial earnings report after the market, right? So sentiment was supported by mixed retail earnings and also release of the Fed minutes, which show official were still divided on the need for further rate cut for this year. So I think the market is holding its breath for some of the data points like the US job report, which due tomorrow. So now looking at the charts, I think it resort to consolidation, but bullish signals have appeared after the bullish candlestick, right? So I think now the index still stuck between the 6,700 resistance and also the 6,500 support. Okay, so looking at our US trading stocks that we have published yesterday, which is Edison International, right? So the stock is on its pending breakout formation uh, at the $59 level, right? So now we can expect this level to be breached and also the stock to travel towards the $61 level on a strong momentum, followed by the next resistance at $63 level. Now, yeah, if the counter reverse, uh, do watch out closely at the $57 level for the immediate support, as it could indicate a trend reversal. Also, we have Dividend Energy Corporation, DVN. So looking at the charts right now, the counter is on its higher high market structure, sitting comfortably above the moving average, eyeing to reach higher towards the $37 level. And if the stock to climb up higher, we could see that it might travel towards the $40 level. So now if the stock slight lower below this $33 level, this might signal to shift a bearish structure. Right. So looking at the China E50 as well as the Hang Seng Index, both indices declined slightly on yesterday's session as the entire market chose to wait and see to digest on the critical Nvidia earning report and the US job data as well, right? So I think the main drag was the tech sector, which fell on the global concern on the AI valuation and some warning for Xiaomi that memory chip cost, right? So I think the market remains fundamentally subdued. I think awaiting for clear direction, cue from the US, and also watching for the Bank of China's monthly loan prime rate decision, which due I think tomorrow, right? So moving on to our WTI crude oil price, well, it fell sharply, I would say sharply, on Wednesday session, driven by industry report, which shows third straight weekly build up in US crude inventory, which reinforcing the supply glut narrative, right? So I think the sell-off was accelerated by news that Russia planned to successfully hit its OPEC plus production quota despite the US sanction, right? Um, so I think despite the unexpected draw, the strong consensus on the high global supply and weak demand kept the price anchored below this 60 dollar level, right? Now, if you see here, the oil price rejected the moving average, still keeping its price below the $60 level, which in line with our uh, uh, neg- uh, negative bias, which we eye for the $57 level in our report. Right, so coming back to Malaysia, looking at the uh, FKLI, well, it closed higher yesterday, right? At its intraday high, right? Driven by late bargain hunting and selected blue chips snapping from the uh, I would say global fears over the possible AI bubble, right? So there, I think the rally was highly concentrated with the financial and also plantation sector, right, or counter, providing which provide the main lift. But I think the broader market was if as decliners outnumber or outweigh the gainers. So investors remain highly cautious, I think, depending on the release of the some of the US data as well as the Malaysia markets data, right? So I think KLCI also went up yesterday, jumping off from the 50-day moving average line. And looking at the FKLI, the index remained supported by the bulls. Well, the uptrend may bump up higher in the coming session ahead. Right, so looking into this month's KLCI performance, I think, I mean, we're kind of expecting that the index to be in the red territory. However, is in a positive or green territory as of today, right? So yeah, not to say that investors should sell their holdings, but rather start to accumulate into some potential names as we enter into better months for December, right? So, based on the performance, day-to-day performance, construction, and also the plantation remains as top gainers yesterday, as investors are looking at broad-based sentiment, eyeing for the strategical theme from construction and also plantation from the MPOP news, right? Hence, we have, I mean, yeah, we are looking at SOP or Sarawak oil palm stocks, right? Also, we got a report recently on this, and now I think the price has breached higher, and based on our Fibonacci, can now look at the targeted resistance at 4 ringgit and 10 cent, 4 ringgit 25, 4 ringgit 25 cent, and also 4 ringgit 40 cent level, right? Yeah, also another stock from another sector, right? But I think the counter seems attractive, which is Westport, right? So now I think the stock is rebounding from the 5 ringgit 30 cent support, which I mean also from the moving average, right? I think indicators are also supporting. Now, if the bullish momentum remains intact, uh, yeah, 5 ringgit and 60 cent together with 5 ringgit and 80 cent can be reached in the coming sessions ahead. Right, so this is our watch list for today, and keep an eye on it. Right, and for our Malaysia trading stocks, we have Sunway, right? So I think the stock has breakout above the 5 ringgit and 50 cent level on strong volume. With that, we expect the momentum to remain uh, bullish and the stock able to climb further to test the next resistance at 5 ringgit and 70 cent, followed by 5 ringgit and 90 cent. So if the stock to clear below the 5 ringgit 30 cent support, this could shift to a bearish structure. And next we have high mobility, right? So the stock experiencing a pending breakout at the 2 ringgit and 65 cent level. So if the stock remains bullish, we're expecting for the price to reach even higher and breach this level and to reach the 2 ringgit and 85 cent in the coming session with high volume. Second resistance is at 3 ringgit and 5 cent. Also, keep an eye at 2 ringgit and 45 cent level for any attempt of reversal, right? And lastly, we got FCPO today, right? So for FCPO, it rebounded higher. Um, I mean, for three straight session, which primarily driven by the rival market after the China book large quantities of the US soybean oil, right? So the rally, I think the rally was supported also by our ringgit and looming supply policy risk in Indonesia. However, gains were heavily capped by persistent concern over the record high Malaysia stock and in plantation sector, right, and continued weak demand signal from India, which saw import fall to a low in last month, right? So yeah, that's all I have for today. I'll stop here and pass the floor to Yijia for her economic update. Thanks everyone and happy trading.
Thanks. So, good morning, everyone. Just a quick update on Malaysia's trade data for the month of October, which was released on yesterday. So, as per the yesterday trade data, we have also revised our full year export growth forecast to 6.8%. So, versus our former projection of 4.7%. So, which is to reflect the strong surge in September and October exports data, which rose by 14% on year-on-year basis on average for these 2 months. So, specifically, October exports surged by 15.7%. So, versus September's trend of 12.2%. Which surprised the market consensus of 7.6% and our in-house projection of 7%. So the stronger than expected export performance was driven by a resilient E&E exports, which accounted for 45% of October's total exports, and it surged by 26.5% on year-on-year basis, so exceeding our in-house forecast of 18%. So on the other hand, palm oil-based manufactured product also supports the outperformance, rising by 23.9%. The growth in total exports was also driven by a sharp rise in re-exports, which accounted for 24% of total exports, and it surged by 36.4%. So by destination, exports to the top 10 markets has increased, except for US, which declined for 2.6%. So versus September's print of 24% for US. This is, I think, for the month of October, it's an ASEAN story, where the exports to ASEAN, which accounted for 28.7% of total exports, gained pace by 20%. So continue the September's strong print of 19.2%, led by Singapore at 27.2%. So meanwhile, exports to China and EU rose by 7.5% and also 23.8% respectively. By products, the manufactured good export grew by 15.7%, underpinned by increased shipments of E&E products, machinery and equipment, as well as palm oil-based manufactured products. So looking ahead, the upgrade is also in line with our recent GDP growth revision to 4.7% for 2025 versus our former print of 4.2%. So on year-to-date basis, exports and imports grew by 6% and 4.7% respectively. Our optimism regarding the external demand outlook for this year and also next year has strengthened. So following the easing of tariff risks and also continued resiliency in E&E exports. So Malaysia overall export performance is expected to be supported by clearer guidance on US tariff rate and also a diversified export base. A broadly uniform US tariff rate across the ASEAN should help to sustain the Malaysia regional competitiveness as well. So external demand is expected to be supported by, as I mentioned earlier on, easing tariff-related risk, Malaysia's diversified product base and also export destination, continued resilience in E&E exports, and also improved clarity on the reciprocal tariff policies following the conclusion of US-Malaysia reciprocal trade agreement in October. The agreement is expected to boost the manufacturing sentiment and further support the sectoral activities, underpinned by Malaysia's expanded exclusion from US tariff measures, as outlined in the Annex 3 of the Executive Order 14346, which covers key export products such as palm oil, rubber, coca, selected pharmaceuticals components, as well as some of the aerospace equipment. So combined with the exemptions under the Annex 2 of the Executive Order 14257, as per April's release, roughly 64% of Malaysia export to US is now excluded from reciprocal tariff, marking a notable easing of US tariff risks and also provide a firmer backdrop for Malaysia's trade and manufacturing momentum. So looking ahead, we will closely monitor the sectorial developments, particularly in semiconductors, given their critical role in Malaysia's export portfolio. While uncertainty remains over the potential US tariff on semiconductor products, the near-term risk appears to be limited, where under the recent US and Malaysia reciprocal trade agreement, So US will also give special consideration to Malaysia's semiconductor sector in tariff negotiation under the Section 232 of the US Trade Expansion Act 1962. So further reinforce the view. So approximately 65% of Malaysia's semiconductor exports to the US actually produced by American firms based locally. So indicating a deep supply chain integration and also greater probability of tariff exemption, thereby reducing the potential tariff risk as well. So despite the lingering policy uncertainty, so we do think that the sustained global semiconductor demand, so driven by AI and other emerging technologies, remain a key tailwind for Malaysia, alongside with our diversified export destination for the semiconductor exports. I think that's all from me. I will just pass the stage to the next presenter. Thank you.
Right. Let me move on to the result review on Solarvest. This is first half FY26 results. Basically, it's within expectations. Revenue of 307 million translated to a core PATAMI of 37.4 million. This came in at about 48 and 49% of ours and consensus full year estimates. If you look at the core PATAMI actually grew 120% year on year, to 37.4 million. Now, to second quarter alone, if you look at the numbers, I think revenue rose about 63% year on year and 23% Q on Q to 170 million. Whereas core PATAMI of 20.3 million, which was up 120% year on year and 80% Q on Q. I think these are, as a result of progress billing for its utility scale CGPP projects, as well as stronger solar electricity sales from its LSS4 plants. The net margins were healthy at about 12%, supported by the margin contributions from projects that are nearing completions. However, we do expect the margin to normalize moving forward as it recognizes more large-scale projects in place. Now they are on track for another record year as it executes its pipeline and its outstanding order book of 1.33 billion, which was up 12.3% Q on Q. In terms of order book comprising of 83% of utility skills contracts, CGPPS and also LSS5. The rest of the order book of 70% came from CNI and residential job. The group is still aims to enlarge its order book by securing additional packages under SS5 and LSS5 Petra. Its cumulative of 130 megawatt power of capacity under PowerVest program will also continue to provide recurring income and developer profit upsides. Now, no change to our earnings as well as forecasts. We keep our target price unchanged at 3.49 ringgit, based on an unchanged 30 times PE on FY27 FPE on a fully diluted basis, as well as DCF valuations for its solar assets. Note that our target price includes 8% ESG premium. We still maintain buy on the stock as we think it will continue to capitalize on the momentum from Malaysia's energy transition initiatives as well as its expansions regionally. That's all from me. I think I'll pass on to the next presenter.
Hi, thanks, Meng. Good morning, everyone. So I will bring you through the results review of Johor Plantation Group. We maintain our buy call with a slightly higher TP of 1 ringgit 80 up from 1.75 cents. So this implies about roughly around 30% upside alongside 4% FY26 dividend yield. JPG delivered another strong set of results for third Q 2025 core earnings. It rose 39% Q on Q and 32% year on year to 100.6 million. So it brings 9-month 2025 core profit to 244 million, up 41% year on year. So this is ahead of both our and consensus expectations at 82 and 85% of full year estimates. So this beat mainly came from lower operating expenses, lower interest costs, and also stronger interest income. So JPG has also declared a 1.75 cent dividend per share, bringing year-to-date dividend payouts to roughly around 4 cents. Operationally, FFB output fell 5% year-on-year in 9 months 2025 due to wet weather. As for October, the decline narrowed to negative 3% broadly, in line with our full year expectations of negative 2%. October saw a strong month with 5% month-on-month growth, but management expects a soft patch in November and December, with output likely to fall 5% month-on-month this year. So this suggests that the last quarter of 2025 for JPG productions may fall somewhere around 7% Q-on-Q, translating to 1 to 2% decline for the full year. For 2026, however, internal FFB may dip again due to accelerated replanting program, but this should be offset by stronger OCP, so we keep our assumptions unchanged. On cost, CPO unit cost rose 9.5% year-on-year to 2,300 ringgit per ton in 9 months 2025, largely due to weaker output. So given expectation of a softer 4Q, JBG maintains that FY 2025 costs will stay elevated at around 2,300 ringgit per ton. And the company has also already applied 75% of its fertilizer requirement for 2025. So looking ahead, fertilizer for 2026 is being secured at 20 to 30% higher prices year-on-year, though part of the cost pressure may be cushioned by stronger ringgit. Consequently, we maintain our cost assumption for now. And after taking into account lower OPEX, lower finance costs, and slightly higher CAPEX for the integrated sustainable palm oil complex, we raised our FY 25 to FY 27 forecast earnings by around 4% per year. And Sawani TP at 1.8 ringgit is based on an unchanged 5 times 2026 forecast PE, which is at the upper end of the peer range. And we believe that premium is justified given that GPG Strong's ESG credentials will support higher realized ASP and is expected the newly set up downstream contribution from second half of 2026. Moving on to SD Guthrie corporate newsflash, we maintain our buy call with an unchanged TP of 6.95 ringgit, implying 29% upside and about 3% FY26 forecast dividend yield. We remain positive on SDG's newly announced joint partnership to develop a 941-acre industrial park in Kuala Johor. This fits well in its long-term strategy to unlock value by developing around 2,000 acres of land per year over the next decade through JFE to joint ventures with experienced property developer. And we expect that SDG to recognize the 526 million land disposal gain in FY26 with recurring development contributions coming in later years. So importantly, that the stocks remain attractive valued at 16 times FY26 for PE at the low end of the 16 to 20 times peer range. So to explain the structure of the deal, SD Guthrie Land Ventures has entered into a subscription and shares agreement with Permodalan Darul Takzim and EcoWorld. So this land will be developed via SPV called Eco Business Park, or in short EBP8. So SDG will hold around 25% stake. Permodalan Darul Takzim will hold around somewhere around 10%, and EcoWorld will hold the remaining, which is equivalent to 65%. So this SPV Perak capital will be increased to 10 million, and SDG will fund its portion internally. This project also will be developed over the course of the next 10 years, and with a preliminary GDV of around 3.75 billion. And the industrial park will include industrial lots, ready-built factories, commercial components to target high-growth industries such as EE, clean tech, and logistics. And the location is also strategic because it's very near with the Senai Airport, which is and also near with the major highways and also seaports. So this give the projects a strong connectivity and also competitive positioning. In terms of the monetizations, EBP8 will purchase 941 acres from SDG at 814.8 million ringgit. So this is well above recent land transaction in Kulai of only 12 ringgit to 15 ringgit per square feet. So this leads to an estimate of 526 million gain, which will only be recognized in FY 2026. As we have already assumed that 500 EBIT per year from property transactions, so we do not revise our earnings forecast. So beyond the land disposal gain, SDG is also set to benefit from recurring development income from this project and other in its industrial port pipeline. With a GDV of 3.75 billion and estimated gross margin of 30%, SDG shares of profit could be 150 to 200 million over the next 10 years, excluding palm-related contribution from the disposed land. So our TP of 6.95 ringgit remains based on the SOP valuations and includes a 4% ESG premiums. At the current levels, SDG is trading at a compelling valuation relative to peers, so supports our initial buy call. Thank you so much that's all for me for SDG and JPG. Thank you so much for joining us for Morning Kappa today. That's all from us today, and have a wonderful day ahead. And we will see you again tomorrow on Morning Kappa. Thank you.